Good morning, lazy landlords. Today's question of the day is from Landlord Ken. Hey, Sylvia, I just refinanced my rental property and I was able to pull up $50,000. Can I use that money to go pay down my personal debt, my mortgage on my primary home? I will answer that question in a second. Hello, everybody. My name is Sylvia Ho, and I'm a financial landlord consultant. I work with landlords to help them save money, save taxes, and reduce the interest that they pay the banks because the banks make a lot of money. I'm also known as the cash damming queen. So Ken is a landlord that came to me and had this question, and my first answer was, well, the $50,000, if it was on a rental property, that debt belongs to the rental, meaning that if you use it personally, you cannot write it off. So if this landlord had let's just call it a 300K mortgage, and they refinanced because there was equity in the property, and they increased it to $350,000, and they got $50,000 put into their bank account. Their question to me is, hey, Sylvia, I have $50,000. What can I do with it? Can I use it to pay down my personal credit cards, my car loan, or my personal mortgage? And the answer is absolutely not. You cannot do that. And then what this landlord's probably thinking is, oh, now I've increased my mortgage from $300 to $350. I can write off the interest cost on $350,000. And that's an absolute no. You cannot do that. If CRA catches you doing that, they can literally negate all the interest costs on your rental property. And literally that rental property becomes bad debt, meaning you cannot write off the interest costs. So my friends, please, if you're going to refinance a rental property, do this instead. Before I give you the answer, if you like the training that I give you every single week, please comment, love, comment below, because it'll encourage me to do more of this video training. If you're on YouTube watching my training, please subscribe. All right. So if you have equity in your rental properties, this is what I would recommend doing instead. Refinance your rental property. I do that on all my properties all the time, and I refinance back up to a 30-year amortization, and I refinance and make sure I have a re-advanceable line of credit, because you always want to have access to tapping in to the equity in the homes. Instead of pulling out $50,000, you are going to put it as a line of credit. And now that line of credit is there for you to use to go buy other investment properties. If you end up using that line of credit for personal use, you definitely cannot write off the interest costs. So for Ken, this is what I would recommend. If you're going to refinance a rental property, pull it out as an unsecured line of credit. Now you have access to $50,000 to do for renovations on the rental property, to go buy an investment property, to buy another investment property, but you definitely cannot use it for personal use. So in Ken's case, he really wanted to take that $50,000, which was his original money that he put down into that property, and pay himself back. I understand the thinking behind that. I would recommend that you go speak to your accountant if you're going to do any of this refinance stuff on your rental properties, thinking that you can deduct the interest costs. All right. So we have the one thing you're going to learn is that you have to keep things very separate when it comes to investment properties. If this debt belongs to the rental property, you cannot use that money for something else. You have to use it for investments only, preferably for that investment for that rental property. So if you're thinking that you want to pay yourself back, go talk to your accountant. Ask your accountant, hey, accountant, am I allowed to do that? The safe answer is no, you can't. Well, you can't. You cannot write off the interest costs, so please don't do that, because it makes it very, very complicated for your accountant and CRA. Now, if you're interested in paying off your primary home mortgage and you thought this was a solution, let me give you another solution. If you're a landlord and you have a mortgage against your primary home, you're going to apply the strategy, an advanced financial strategy used by wealthy Canadian landlords called rental cash damming. Rental cash damming is a CRA approved strategy that allows you to pay off your primary home mortgage much, much faster than your current amortization, but legally, and still be able to deduct all of the interest costs on your mortgages on the rental properties. All right. So what is rental cash stemming? Rental cash stemming is basically a conversion tool where you convert your bad debt, the mortgage that's on your primary home. The reason I call it a bad debt is because it's not tax deductible, because we personally live in it. So here in Canada, if you live in the property and it's for personal use, you can't deduct the interest costs. But if it's a rental property and you're trying to make money, then you can deduct the interest costs. So your mortgage on your personal home, you cannot deduct the interest costs. So what this strategy does is it takes your rental income. So let's just say you're receiving $5,000 a month in rental income. You're going to take that $5,000 and you're going to prepay your primary home mortgage. So if you owe $500,000 on your primary home mortgage, you're going to take the rental income from your rental property and you're going to do a lump sum payment on your primary home. And then your next question would be like, what? Hold on, Sylvia. If I get $5,000 in rental income, I need to pay the rental expenses on my rental property. So how am I going to pay the rental expenses? Well, you need a very specific mortgage product. It's called a re-advanceable line of credit. So you take the $5,000, you pay down your primary home mortgage, you get a line of credit, and you use the line of credit to pay for all your rental expenses. Now, CRA is very specific in how you do this strategy. This is a very dumbed down version of how you do it. But essentially, you are paying down your primary home mortgage by $5,000, which is $60,000 every single year on top of your regular P&I payment. Obviously, your mind is turning and you're like, oh my goodness, if I could pay off my primary home mortgage by a minimum of $60,000 every single year, my mortgage is literally gonna melt away. And that's what's happening with all of my rental cash stemming clients. They're watching their mortgage melt away. I have a client that just started 3 months ago. They're getting $11,000 in rental income. In 3 months, they have paid down their primary home mortgage from $735,000 down to $700,000. And the beauty about all this is that it does not cost you an extra penny out of your pocket to get these benefits. This is a very, very rare strategy. It's a rare financial strategy where you can gain benefits but not have to bring up more money. What do I mean by that? Well, for example, if you want to save money for retirement, you have to bring out money to be able to save for retirement and get that retirement fund. But not this strategy. You don't have to bring out more money to gain the benefit of watching your mortgage melt away. All I'm proposing is that you rearrange the way you use your rental income. So if you're a landlord that's getting $5,000 in rental income and you're depositing into a bank account, and from that bank account all your rental expenses go up and then you're left with zero and then you rinse and repeat on the first of every month, stop doing that, my friends. That's what 99% of landlords are doing. I used to do that, but you're losing a ton of money. Again, instead what you're going to do is you're going to take your $5,000, pay down your primary home mortgage, use a line of credit to pay for the rental expenses. If you are interested in watching and seeing how you can melt away your primary home mortgage 8 to 12 years earlier than your current plan, please comment below, melt, and I'll send you a personal link for a complimentary 45-minute call where I'm going to do a cash flow analysis and I'm going to show you how much money you are actually leaving on the table today. Thank you so much for tuning in, everyone. If you're a landlord and you have a question, please comment the question below and I'll answer it in my weekly training on Wednesdays. I'm Sylvia. I'm known as the Rental Cash Stemming Queen. I help landlords save money, reduce the taxes, and decrease the interest that they pay the banks. Thanks so much for tuning in. Until next week. Bye now.